All right, let's talk about it. Real estate versus stocks. It's probably the biggest debate in all of personal finance, right? But what if we just ignored all the hype for a second and actually ran the real numbers? The answer? Well, it might just change how you think about money forever. So, let's get into it. For the longest time, I was completely convinced that owning property was the one true path to wealth. I mean, it's tangible, right? You can touch it, it feels stable, it's what all the smart, wealthy people seem to be doing. But the deeper I dug, the more I started to realize I was just plain wrong. And for me, it all started right here, with $50,000 sitting in a savings account. Now, that is a life-changing amount of money for a lot of people, and it puts you at this massive crossroads. You've got this cash. What do you actually do with it? Where do you put it to work? And the advice I got, oh man, it was deafening. And it all pointed in exactly one direction. My family, my friends, basically society as a whole, everyone was saying the same thing. Real wealth is built with real estate. It honestly felt like the default choice, like it was the only serious option on the table. But something about it just didn't feel quite right. So I made a decision. I was done. I was going to stop listening to all that noise, and I was going to start doing the math for myself. I wanted a full, brutally honest breakdown of both paths. And look, I'm not talking about some quick back-of-the-napkin calculation here. I mean the real math, the kind that accounts for every single hidden cost, every hour of your life you're going to spend on it, and that one magic force that just changes everything over time, compounding. So, to really figure this out, let's do a little thought experiment together. We're going to follow two people. Let's say they're identical in every single way. Same savings, same income. We'll watch them for 2 whole decades, but they make just one different choice at the very beginning. The question is, how different will their lives look 20 years down the road? Okay, so let's meet our two characters. On one side, we've got Jake. He's about to become a landlord. And on the other side, we have Marcus. He's going to be our passive investor. So here's the setup. Jake, he takes his $50,000 and uses it for a down payment on a $250,000 rental house. He takes on a mortgage, he gets a tenant, the whole shebang. Now Marcus, he takes his $50,000, puts it all into a simple stock market index fund, and then just sets up an automatic $300 contribution every single month. That's it. No debt, no tenants. All right, so we're going to check in on these guys at 3 really key moments. First, after 3 years, just to see how reality starts to set in. Then we'll jump to the 10-year midpoint to see how they're doing. And finally, we'll go all the way to the 20-year mark to see the final score. Okay, so here we are 3 years in. Jake has collected almost $17,000 in rent. I mean, that sounds amazing, right? But hold on. Once you subtract property taxes and insurance and, that new water heater he had to buy, plus a surprise roof leak and that 1 month the place was empty, his actual cash in his pocket is more like $3,000. Now, his equity has grown nicely, you gotta give him that, thanks to leverage. And what about Marcus? Well, he's done absolutely nothing. He's literally just let his money sit there. His initial $50,000 plus those monthly contributions has just quietly grown to around $76,000. 0 late-night phone calls, 0 emergencies. Okay, let's jump forward. We're at year 10 now. Jake's property value has gone up, and he's been chipping away at that mortgage. So after a full decade of being a landlord, his total equity is sitting at about $170,000, a very, very respectable number. So what about Marcus? His portfolio is now worth about $165,000. Whoa. Okay, and this is where it gets really interesting, right? They are shockingly close. Jake's got all that leverage in the physical house, but Marcus has this quiet, invisible power of compounding, and man, it is catching up fast. And now, the moment of truth. The final tally after 20 long years. Jake's equity in his rental property lands somewhere between $400,000 and $500,000. A huge accomplishment. And Marcus? His simple hands-off portfolio is, in the exact same ballpark. Financially speaking, it's pretty much a tie. So you might be thinking, okay, if the final numbers are basically the same, then what's the big deal? Well, that's the whole point. The destination might be the same, but the journey to get there was completely and totally different. See, it's not just about the number on the spreadsheet at the end. It's about the real price you pay along the way. Yeah, this is the side of being a landlord that nobody really likes to talk about. It's not just about cashing those rent checks. It's about paying for empty months when you can't find a tenant. It's about fixing leaky roofs on a Sunday afternoon. It's replacing a furnace in the dead of winter. You either pay a property manager with your money, or you pay with your own time and your own stress. We're talking hundreds and hundreds of hours. And that right there, that leads us to the single most important takeaway from this whole thing. The financial returns, they ended up being almost identical. But the life you have to live to get those returns couldn't be more different. Think about it. Jake's journey was all about debt and stress and having all his eggs in one basket, one single illiquid asset. It demanded his time, his energy, his attention. Marcus's journey? It just required patience, and in return, it gave him flexibility, diversification, and honestly, peace of mind. So, what's the real lesson here? It turns out the whole debate isn't really real estate versus stocks at all. The real secret to building wealth, it's not about picking the one perfect asset. It's about choosing the right system. And at the very heart of Marcus's success was this one simple, beautiful concept: compounding. It's like this invisible engine that just does all the heavy lifting for you. And yeah, it's super boring and almost invisible for the first, say, 5 years. But then it becomes this astonishing, unstoppable force for the next 15. I mean, just look at this. Over those 20 years, Marcus put in a total of $122,000 of his own money. But the growth, the money that his money made all by itself, was over $300,000. The vast majority of his wealth came passively from the market, not from his savings. That is the power of a system. And this is the key. Real wealth isn't the result of one big, clever move you make. It's the outcome of a simple, repeatable system that you can actually stick with for decades. It doesn't matter if that system is real estate or stocks. Consistency, that's everything. So, what should you take away from all this? I think it boils down to one simple rule to live by. Don't just follow the hype. Don't listen to what your uncle says or what some random person on the internet claims is the best. You have to run the numbers for your own situation, for your own life. And that leaves us with the real question here, the most important one. It's not which asset is better. The question is, which system actually fits your life? Are you built for the hands-on, high-stress, high-leverage world of a landlord? Or are you better suited for the patient, hands-off approach of a passive investor? Only you can answer that.